If you miss these 2025 tax deadlines, you could be subject to additional taxes, penalties, and on top of that, interest fees, which altogether could end up costing you thousands of dollars more out of your pockets. I see it all the time as a licensed CPA that tax plans every day at mycpacoach.com. People don't file their taxes on time, they miss their estimated tax payments, or they file an extension without understanding that that extension does not grant them more time to actually pay their taxes. So look, if you want a simple guide on what you need to do this tax season to avoid all of these extra penalties and fees and stress, just watch this short video until the end for everything you need to know. All right, so let's walk through these deadlines in order, and I'll also give you some important tips to keep in mind if you cannot meet them. Date number 1, the March 15th deadline. A lot of our subscribers here own businesses, and if that's you, then this is the first due date you need to know about, with the exception of sole proprietors and single member LLCs, which we'll talk about in a second here. But look, if you operate a partnership, or in other words, 2 or more individuals own your business, then you would need to file a 1065 tax return by March 15th of this year. Or if you operate an S corporation, which can be operated by 1 or more individuals, then you would need to file an 1120S tax return due by the same date. Now, keep in mind that these are pass-through entities, meaning that when you file these tax returns, no tax is typically due, at least on a federal basis. Instead, the income you earn from these entities will pass through to your individual tax returns, which is a separate tax return with a separate due date. So let's go ahead and talk about that. Date number 2, the April 15th deadline. Now, this is usually the due date for all individual tax returns. So if you earn W-2 income, 1099 income, have rental properties, investment gains, and so on, then this is likely going to be your tax return due date. Plus, if you operate a trade or business as the only owner, whether it's a sole proprietorship or unincorporated business, or single member LLC that is solely owned by you, then this would also be your tax return due date as well. Now, these types of businesses are required to complete Schedule C on their individual tax returns, or Schedule E if they own rental property, as opposed to being required to complete a separate tax return due on March 15th, which we just talked about. Now, also, in addition to individuals, many C corporation tax returns are also due by April 15th as well, depending on their fiscal year end, which they can control. So if you file and pay your taxes correctly by these dates, then you will be off to a good start here. However, over 15 million taxpayers do not file by these dates. So let's talk about tax extensions for a second here, and some other key dates that you need to be aware of as well. But first, let's address why there are millions of taxpayers filing their tax returns late every year. Now, usually this is a result of missing information that is needed to file their tax returns. For example, if you are missing W-2s, 1099s, or K-1s from businesses that you are invested in, it may not be a good idea to file your taxes without that information. Because what happens is, if you file your tax returns with missing information, it may trigger an audit or red flags with the IRS, which could then result in IRS letters, penalties, interest, and so on, which we do not want. Now, outside of that, many taxpayers also do not have their own financial records in order for them to be able to file their taxes on time. For example, many business owners and real estate investors do not have the appropriate financial statements to even start their tax returns. And the reason why is because the IRS requires business owners and certain investors to maintain financial records, which is usually done through a process called bookkeeping. And when your bookkeeping is not done, you cannot file your tax return, at least in most cases. And this process can take several months, which usually causes taxpayers to be late on filing their returns. So if you operate a trade or business, let this be your early warning to get your books together as soon as possible, or just hire someone to help you with this ASAP. And those are just a few examples. There are several other causes that may be out of your control, but whatever the case may be, if you believe you will miss your tax return due date, then you may want to consider filing a tax extension. But let's address this because many people misunderstand tax extensions. So first and foremost, what is a tax extension? A tax extension grants you an additional 6 months to file your tax returns without being subject to the failure to file penalty. So if your tax return due date is March 15th, then an extension would give you until September 15th to file that tax return, or until October 15th for tax returns due on April 15th. Now, while a tax extension grants you more time and waives the failure to file penalty, it does not waive the failure to pay penalty. This is a separate penalty that is assessed if you do not pay your taxes on time. And what a lot of people do not understand is that filing a tax extension does not grant you more time to actually pay your taxes. For example, let's say you filed a tax extension for a return that is due on April 15th and filed it on September 30th before the October 15th extension deadline. And let's say when you filed that return on September 30th, you owe $10,000 in taxes. Well, even though you filed that tax return before the extension deadline, you would still be subject to the failure to pay penalty for not making that payment by the original tax return deadline. Plus, additional fines and interest will be incurred for paying it late as well. So if you do file a tax extension, remember, a tax extension grants you more time to file your taxes, but it does not grant you more time to pay your taxes. Therefore, if you do file an extension, you should still estimate the amount of tax liability you will have and make that payment before the original due date of your tax return to avoid this penalty. Or ideally, this is something that your CPA will be able to do for you if you find yourself in that situation. Okay, so the failure to file penalty can be avoided by filing a tax extension. The failure to pay penalty can be avoided by paying your taxes by the original deadline. But there is still one common penalty that catches people by surprise: the estimated tax payment penalty. So look, if you expect to owe $1,000 or more in taxes when you file your tax return, and you did not withhold enough taxes from your W-2 paychecks or make estimated tax payments, then you may be subject to this penalty. And basically how it works is that you must have paid at least 90% of the tax you owe on your current return, or 100% of the tax owed on your prior year's tax return, minus any W-2 withholdings for federal taxes you have already made. Now, depending on the time that you're watching this, it may be too late for you to do this for the prior tax year, but go ahead and make note of these dates so that you can start making estimated tax payments correctly going forward. And to help you with this, I have already published a step-by-step video guide on number 1, how to make estimated tax payments, and number 2, how to remove IRS tax penalties in the event that you are subject to any of the penalties discussed so far. So make sure you subscribe to learn more about those topics. And also, if you believe that you will be subject to a lot of taxes when you file your next tax return, and you want a plan that is guaranteed to reduce your taxes going forward, just apply to work with one of my CPAs today at mycpacoach.com.